Well, if you're in the real estate game, one of the things we have to do is we talk about mortgage rates. If we're going to talk about mortgage rates, we should talk about the 10-year note. And if we're talking about the 10-year note, 10-year treasury, we should talk about the federal funds rate. I'm going to do this with Matt, the mortgage guy. And he has actually found a source that is making a call on all three of those for the next several years. So I thought we should take a look at it. We'll look at the graph together, kind of bat it around and see what we think of this. So, buddy, what'd you find? What's going on?
Yeah, I mean, there's all kinds of predictions, and some of them are like, headline grabbing, sub 4% next year. This one went a little deeper, and I'll send you a link so people can read the full article. We know, and others should know, these three things: the Fed funds rate, the 10-year Treasury, and the 30-year fixed rate mortgage are intertwined. They kind of move in lockstep. It's not like the Fed does something on a Wednesday and that immediately translates to mortgage rates. But if you look at the graphs over time, they follow each other, right? And so I thought, while it was a little bit optimistic on how much interest rates are going to go down over the next couple of years, I thought it at least was well put together. And it might have been calculated risk blog. I'll find the source, but it's not just some random headset jockey shooting a video, right? And making a wild claim, right? They can substantiate it and back it up with some data. So I'll share it here, and we'll talk through it. When I looked at it and I saw the 30-year at 6.5, I was like, oh, this was from a couple months ago, but nonetheless,
let's level set that the legend is there, but everybody may not see it. So the yellow or gold is mortgage rates.
Correct.
And really from 2023 to the left, those are historical numbers, and to the right are the predictions. Then we have blue, which is the federal funds rate. They're calling 5%. So that's a little low, right? Because now we're at 5.25.
Right.
And then red is the 10-year treasury, which again is a little low because we're kind of near 4% today. But I think what's most interesting is the spread between the red and the yellow.
Exactly.
Right. This is something that I've been trying to highlight, and this does a pretty good job of it. If you look back at, say, 2018, the spread between the red and the yellow is, I don't know, call that, what is that?
1.6.
1.5? 1.6?
Yeah. 4.5 and 3.9, right? So it's about 1.6. And historically, you've talked about it, 1.6 to 1.8 between the 30-year mortgage and the 10-year treasury. And for those that aren't following, the 10-year treasury, when this report was done, that's 3.5. Mortgage rates are 6.5. Right now, it's more like the 10-year treasury's 3.96 and rates are 6.96. Still a 3%. Financial people will call it 300 basis points and sound a little fancier, but 3%, right? And you can look at it, right? 2021, this is 1.5, and this is about 3. It's about a 1.5% spread. I've talked about it. You've talked about it. It's such a wide spread because of volatility. When uncertainty and volatility come out of the market and we're in more calm economic waters, which we hope to be in over the next few years, the spread just comes down. You see it, right? Like this graph shows it really well, Mike. That's why I saw it. It's like, it's kind of cool. Like this squeezing between the 30-year mortgage and the 10-year treasury back to normal levels.
Yeah, and what I appreciate about it is it's not particularly sudden. Like if you look at 2025, which is, call it 2 years away, you're still basically 200 basis points spread.
Right.
You don't get back to historical averages really till 2027, right? Maybe 2026. So I think that shows caution, which I can appreciate. So that's the first thing I noticed, right? We're going to go from 300 basis point spread to, 1.5 over the next several years. So that's cool. The next thing I notice is we are now at peak 10-year treasuries, which is kind of where all this starts. So if the peak is in and the spread shrinks, it means mortgage rates are coming down. That's just how it mathematically works. And then the other thing that I've noticed, and this one I probably will push back on some, they're seeing sub 5% mortgage rates. I don't know, 2024, certainly 2025. That,
And I think, you know,
that,
when I look at it, it's a little bit optimistic. The other thing I noticed, Mike, was 4.25 Fed funds rate in 2024, and then
ooh,
2.25 by 25. Like
ooh,
that's
massive.
that's a lot of Fed rate cut. You know, there's going to have to be some turbulence, or, you know, my thought, and I've looked into this. I don't follow this stuff as closely as you do or others, because I, truth be told, I don't want to be an economist.
Yeah.
I want to write mortgages,
yeah.
do the fun stuff with real estate. But I know, and I've seen it, and I've heard people talk about it, like the Fed is likely to overshoot. The Fed is likely to, you know, already, I think, you know, these might be me pulling some words from Mike Zuber. Like, you can pause and let it run, bro. And I think you've done the work. But, you know, another hike in July, that if they do one in September, they're going to overshoot. Inflation's going to be down to 1.7, and then they're going to go, oh gosh, right? Like we can do some cuts, but 8 25 basis point cuts or 4 50-point basis cut, whatever it takes to go 2% down between 24 and 25 is an aggressive outlook, I think.
Yeah, I agree. I personally hope we don't ever see funds rate below 2% again. I'm going to guess that Powell wants to keep Fed funds around 3%. That gives him enough cushion just in case there's a true emergency, you know, the once in a lifetime, every 20-year things. I don't think we're going to see Fed funds rate below 2% in 2026, for example.
Right. I would agree with that. And for those out there that will ask, because I get asked this, Mike, when are rates going back to 3%? It was probably a once in a lifetime event for those who got to witness 20 and 21, right? Those of us who had the great fortune of being able to finance some stuff at those historically low rates, good on us.
Yeah.
Might well be a once in a lifetime event. And for, like, I agree with you. Like, they've got to keep some ammo in the gun.
Yeah, exactly.
In case something dramatic happens, you know, because you just unload the clip and bring it under 2% and you got nothing left to shoot if needed.
Yeah, we can't do that. The other thing that I point at this is that blue drop from 23 to 24, which is the funds rate. I would actually be a betting man to say that 24 is more of a drop, because right here it shows that 25 is 200 basis points. I suspect that when they cut, they're going to cut fast. So I would expect once they're cutting, it will be more dramatic. So we might go from 5.25 to 4.5 quickly, and then anything from 4.5 to 3.5 is more slow. So I think I would have that inverted personally, but I mean, this is one person's opinion. We'll link the source below, but I thought this was a very interesting look, and it really does show. For me, it shows the spread, how wide it's gotten, and it shows how long it might take to get back to normal. So pretty good view, man.
Interesting stuff, man. If you want to geek out on mortgage stuff, connect with me and my team. Go to greatmortgagebroker.com.
There you go, buddy. Thank you so much.
Thanks, Mike.